Financial stocks are falling because Trump's credit card rate cap plan just rattled investors, and what looks like a simple consumer-friendly idea is now shaking the foundations of Wall Street. In a single proposal, banks lost billions in market value. Credit lenders saw their futures questioned, and investors realized something unsettling. This wasn't just a policy suggestion, it was a warning shot. Because when politicians touch credit, they're touching the bloodstream of the economy. And what happens next could reshape how Americans borrow, spend, and survive financially. Let me show you what just happened and why it matters more than anyone expected. They were talking about credit card interest rates. You might be thinking, wait, credit cards? Seriously? Yes. And this story isn't fluff or market noise. It's a real shockwave moving across global financial markets. And it started with one proposal from the President of the United States. Is this the start of something bigger or just a market overreaction? Because what you're about to hear will reshape how you think about credit, banks, and political influence on markets. If you're holding financial stocks, if you depend on credit, or even if you just have retirement savings, this matters because when markets move like this, it means something deeper is shifting. The story unfolds. What happened? So what actually triggered this sell-off? On Friday, President Trump renewed a campaign-style promise, this time on credit card interest rates. He called for a one-year cap on credit card interest rates, a maximum of 10% per year, to start on January 20th. To most Americans, that might sound like a consumer-friendly idea. After all, average credit card rates in the U.S. hover around 20 to 30% rates many people struggle with. But here's where it gets complicated. Banks and credit card companies make a huge portion of their profit from the interest they charge on everyday purchases and revolving balances. Cap that interest rate artificially, even for 1 year, and you immediately squeeze the lifeblood of their business model. When markets opened on Monday, major bank stocks were hit hard. Citigroup, JP Morgan Chase, Bank of America, and Wells Fargo all fell. Credit-focused lenders like Capital One and Synchrony Financial were even worse off. Synchrony plunged double digits, the largest drop among S&P 500 companies. Even globally, big lenders like Barclays slid sharply due to U.S. spillover fears. And the pain didn't stop there. Payment processors Visa, MasterCard also saw declines as investors fretted over reduced activity and profits tied to credit card usage. This wasn't a random dip. This was panic. Fear meets uncertainty. Why investors are nervous. Now let's pause for a moment and contextualize this. Banks aren't just interest machines. They're the plumbing of the economy, lending to consumers, backing businesses, and supporting transactions large and small. If credit card revenue suddenly drops, if interest income is capped, profits fall, margins shrink, risk models break, and that means investors don't just see declining sales, they see unpredictability, they see risk, and they see the potential for credit contraction. Because if banks earn less from credit cards, they may tighten lending, raise fees, restrict access for higher risk borrowers. Think about that for a second. For millions of Americans who rely on credit cards for everyday spending, emergency expenses, or to bridge gaps in income. This isn't just market talk, it's real-world impact. And while Trump's plan has no clear mechanism for implementation yet and would likely require congressional approval, investors didn't wait to react. Markets hate uncertainty. Markets fear regulation that could hurt profits. And right now, traders are betting that the road ahead looks choppy. The ripple effects, winners, losers, and the future. When Washington puts big ideas into play, even just talk, it can trigger massive market shifts. And today's sell-off is proof. But here's where the plot twists. Not everything is losing. Alternative lenders and fintech players, especially those that don't depend on interest spreads, actually saw increased interest from investors. BNPL companies like Affirm and Block gained, as traders anticipate a shift toward non-traditional lending if big banks pull back. This is classic market dynamics. One industry gets squeezed, another potentially benefits. But there's another layer here. Some analysts warn that a forced rate cap could reduce access to credit for the most vulnerable borrowers, the very people a rate cap is meant to help. You can see the paradox. A policy that looks protective on the surface might actually restrict borrowing, shrink credit access, and push consumers toward less regulated, more costly lenders. This isn't just about stocks falling or rising. It's about how policy and markets interact. It's about perception versus execution. And it's about the fact that markets reacted before any law was passed, which tells you something important. Investors are afraid, not of the policy itself, but of the uncertainty it creates. And that fear alone can move trillions in capital. The takeaway, what happens next? So where do we go from here? There are three possible paths. 1. The policy dies in Congress. Most experts believe Trump's cap would need legislative approval, something unlikely to happen quickly. If that's the case, Markets might rebound once the political risk fades. 2. The policy passes, with compromise. If a version of the cap is enacted, banks may be forced to restructure, tighten credit, or adjust lending models. That could fundamentally change how consumer credit functions in the U.S. 3. Markets shift permanently. Even if the cap never becomes law, the idea alone has introduced political risk into the banking sector, and that risk changes investor expectations, possibly for the long term, which means this story isn't over, it's just beginning, keeping you ahead of the narrative. So if you want deep, unbiased, comprehensive explanations of how financial policy impacts markets and everyday life, make sure you're subscribed, because what's happening right now isn't old finance, it's new economy. Policy moves markets, markets shape lives, and uncertainty defines the winners and losers. Stay informed, stay curious, and stay ahead, because the next twist in this story could be just hours away.